remember endowments? Yep, people used to invest using endowments. Nowadays you've got unit trusts, you've got money market funds, you've got bonds. You can do absolutely anything with money, but which is the right savings vehicle for you? This is Tonight. I'm Bruce Whitfield, and tonight I speak to David Crossley, Practice Manager at BDO Wealth Advisors, and Craig Sher, who's the Head of Product Development from Discovery Invest, to find out. Endowments, so delightfully old-fashioned, David. I mean, the sort of thing I think my parents might have bought and still regret having bought to this day.
I think, Bruce, that at the time your parents brought endowments, it was probably the only investment vehicle that was available to them, because the advent of unit trusts and other more sophisticated investments came later. But endowments have been given a bad press.
That's because they were shocking, poorly structured, expensive, poor yielding products, weren't they? I mean, that's a good enough reason for bad press, no?
Yes, I think that is a good enough reason for bad press, but you've got to remember that endowments, even as they exist today, have certain tax advantages that possibly unit trusts don't. My experience is that not as many endowments are sold as your parents would have brought at the time, and the life insurance and the investment industry in South Africa is one of the most sophisticated in the world. So products have morphed and have been expanded and have been developed, which are infinitely, in my opinion, more efficient than endowments ever were in those days, yes.
So the bad press was justified?
Up to a point, I think it probably was justified, yes. I can't deny that. But a lot of people made a lot of money out of endowments for various reasons. People took out an endowment to pay for their children's education, for example. And that's where the word endowment comes from. You endowed somebody with a lump sum of money, or you managed a lump sum of money in order to create an income. So they weren't altogether bad. I mean,
the products are a product of their time.
Yes, of course. Yes, of course.
I've not ever seen an endowment advertised anywhere on a Discovery leaflet anywhere. Great.
No, Bruce. I mean, I think the way that we see endowments today is very different to how maybe we saw them before. Today, an endowment is really just a tax chassis for your investments. So you would have, like, say, you could have an RA, which is the one type of chassis, which is a tax-free growth of your investments. You could have endowment, which is a different type. Then you could have sort of your LISP linked investment service provider, which just you kind of just put your investments in. Now the difference between the three of those is really your access to the money, so how quickly you can get your money out of it, and the tax rates that are applied. So an endowment today is really just a chassis that applies a certain tax rate.
I mean, should we be investing for tax rates, or should we be investing for performance? There's people who don't like governments very much try to dodge the tax, but do they not ultimately prejudice themselves at some point, David, in terms of the returns they might get? Because there's a complexity which comes into structure.
There is. I think, to put it very simply, an endowment allows you a tax-free payout after a minimum period of 5 years. Whereas if you take a unit trust, it doesn't have a 5-year mandatory period before you get any money out of it, but the unit trust structure is subject to capital gains, and if you cash in a unit trust, you will receive a certificate to tell you how much of capital gains you're going to have to declare on your tax. So for those people who want to be patient and create the right investment within the endowment, can still make a reasonable amount of money, and it's free of capital gains. It's a tax-free benefit, if you like.
When it comes to structuring investment products, I mean, National Treasury would love to see simplicity. As consumers of financial products, we would love to see simplicity, because we simply don't have the time to try and unpick what the clever guys at Discovery and other places do to create complex products.
Yeah, I think that, again, it does, as we said, endowments do have sort of a history of not being that clear. But I think endowments today are, as we said, they're just a tax chassis to hold your investments in. So you could choose your same set of unit trusts from a range of different unit trust companies, and you could put them in your endowment, or you could put them into your RA or any other type of tax chassis. The endowment structure is really just, almost a holding for your investments that you put them in.
Why would I go for an endowment as opposed to an RA? I have money in an RA structure right now, and I hope I won't touch it for many, many years to come.
Well, and an RA and an endowment are kind of one and the same thing. Okay. It's the same sort of chassis. It's the tax deductibility of an RA and the possibly restrictions is a wrong word, but there are certain constraints on how much sort of investment go onto certain areas. And it has certain limitations in terms of what happens when you get to maturity. So it's much the same. An endowment is paid for with after-tax money. So the proceeds at the end of the day are tax-free.
Yeah.
It's very much the same sort of thing. And really it comes back to saying, well, maybe you need both, but you need somebody to tell you why in terms of your financial planning.
Absolutely. And it does come down to why, and it depends on what life stage you're in and all of that sort of stuff. An endowment perhaps more appropriate post-retirement, and the RA structure while you have income coming in and you're adding to your wealth?
Yeah, I would say maybe the other way around, that endowments are probably pre-retirement. The reason for that is the way that endowments are taxed. Let me just take a step back. The appropriateness of investment depends very much on your particular circumstances and your tax rates. So if, for example, you don't pay any tax, for example, then...
Which for the record, Mr. Moyani, I do. Sorry, just want to get that clear. He's picking fights with everybody at SARS. I hate to think what he's going to do outside.
Then perhaps an endowment wouldn't be the right thing for you, because an endowment embedded in the tax rate in the endowment is a tax rate of 30%.
Yeah.
Whereas if you were a high earner and you were paying at a marginal rate of 40%, then an endowment becomes the right investment for you, because you only pay 30 in the endowment structure.
Got you.
So when you're post-retirement, I suppose it depends on how much income you're getting at that point in time.
I think coming back to the notoriety that you attach to endowments, we went through a period of time in South Africa when people were using endowments to hide money in. People were able to borrow a great deal of money out of an endowment and then repay that money with money that may have come from questionable sources, you see. So when the laws changed, it cut off all those loopholes, which meant that the endowments reverted back to what they were really intended to be, and that was a savings vehicle to create a lump sum at the end of a particular term of years.
And so much also in investing depends on cost and what you pay for the privilege of investing. There's a huge swing worldwide. That nice Mr. Bogle has written books, and guys who have written books on buying indexes rather than actively managed funds. And there's a strong argument made. 2014, the vast majority of active funds were whipped by the passive investment of the all-share index, which wasn't spectacular in the first place.
Yeah, I mean, I think the key here is that an endowment doesn't differentiate between what investment you want to put inside it. So you could put an index track in it, or you could put an actively managed fund. And
let's just look at active versus passive. I mean, 2014 was a good year to do a comparison. If you're a 10x investments, for example, the guys who do the passive investing. Passive investing is a flavor which is certainly coming to the fore.
I think worldwide there has been a major trend. In South Africa, we haven't seen as much of it. Definitely, the majority of funds are going into active.
Is that a PR issue for the passive guys, or is there a sound reason for it?
I think the active managers have done very well. Generally, they've got a very, very strong track record, particularly in South Africa. But having said that, we don't know going forward which is the better way. I think the key is to have the right advice and to choose based on what is.
But cost is imperative as well, isn't it?
Cost is very important, and I think that might actually come back to the usefulness of the different wrappers that you may choose. A lot of innovation has happened around endowments.
Is it understandable innovation for the mukhus of the world?
I think that's absolutely key. That disclosure has to be absolutely, it's absolutely critical, because at the end of the day you get burnt if you don't give clients the right disclosure. But definitely most of the innovation in that has been around the endowments and the RAs as opposed to just traditional unit trusts.
And that is, it's a really, I had a cousin who had a LISP. He's outgrown it now, but now the LISP is an investment, is a way of structuring investments. The complexity of the stuff needs to be, perhaps the language needs to be simplified.
I think it's worth bearing in mind that again, people make things complex. Unit trusts are managed on the basis of a mandate. So if you happen to have a low risk aversion, you can choose a unit trust or a series of unit trusts that have a low risk mandate. You can have a balanced risk mandate. You can have aggressive risk mandate. So between that, you can put together a nice little parcel that suits your particular stage in life. For example, for an elderly gentleman like me, I'm sort of going towards the balance to possibly the income related type of thing. But if I may just go back to the historical aspects of unit trust from experience, when my children were born, and that's a number of years ago, I took an endowment policy out for both of them. In those days, the huge figure of 25 Rand a month, I think, and
I only wish I had.
they didn't perform spectacularly, but what it did allow me to do, my daughter had an overseas trip and a 21st birthday, which was important to her, and my son wanted a motor car. And I was able to achieve those 3 goals for them by creating those endowments when they were born. So the planning aspect of it is almost as important as the vehicle that you use to achieve the goal.
Ultimately, does the vehicle matter as long as you're doing it? Whether you go and you put it into Satrix 40 or you put it into a unit trust or you use an endowment structure, does it really matter ultimately, as long as you're actually doing the investing?
I think doing the investing is absolutely key, and it's definitely one of the most important things. It's how much you contribute. The other 2 factors which are very important, I suppose, is the fees you pay and then the tax rates that you get. And if you can optimize around those, like choosing an endowment or not choosing an endowment or choosing a different, you can definitely make a very big difference to your end result.
Who got the better deal, your son or your daughter?
Well, it was their choice. You know, I had more fun with my daughter because, of course, it was her 21st birthday and we invited all our friends. So
Of course
I piggybacked. But I think that the important thing, irrespective of what you choose, it's decision and time equals reward.
Absolutely.
And that's where it is. And so many people in this country do not make that conscious decision to put money away when they should. They only wake up when it's too late, and they know they're not going to make the goals that they really wanted to achieve.
And that's ultimately when people start doing stupid things.
Absolutely, yes. And that's when they start taking chances and in investing in these strange pyramid schemes, and because get rich quick out of desperation is sometimes the temptation, which causes all the chaos.
Absolutely, it's the desperation. But gentlemen, thank you very much for your expert views this evening. David Crossley, Practice Manager at BDO Wealth Advisors, and Craig Sher, the Head of Product Development. You guys like to make things complicated, don't you?
No, we like to make things simple.
I'm talking about him. I'm talking about him. You guys might be
maybe
simple.
it's product development people who make them complicated. We like to try and keep them simple at my end.
There we go. Better we'll leave it there. Thank you for watching. There'll be more tonight, tomorrow. Till then, good night and goodbye.